Let's take a look at futures this morning because the markets, despite the overnight developments and more of these tensions in the Strait, markets are higher in the pre-market. Dow is up 132, S&P up 24, NASDAQ up 159. Let's take a look at oil. Oil prices are actually falling. We're still above $100 a barrel on both the contracts, but oil is down, and not by it's a substantial amount here, as you're seeing on your screen. President Trump's Project Freedom is ramping up. Senior officials are telling Fox that major combat operations are closer to unfolding after Iran fired on American vessels in the Strait, and they targeted the UAE with drones. The U.S. forces responding, sinking 6 Iranian small boats yesterday. President Trump is warning that force is going to be used if shipping is threatened, and we're seeing some of that happening overnight again. Let's bring in Future Standard Chief Market Strategist Troy Gayeski. Troy, you know, markets on edge over supply disruptions, but really you've got this firmer tone this morning. What do you make of it?
Yeah, so in the ultra short term, you're going to continue to have this tug of war. It really started yesterday between, oil prices going higher due to increased hostilities and kinetic action in the Gulf versus, very strong fundamentals of the U.S. economy, both in terms of real and nominal GDP. And also when you look at whether it's private equity or public equity, revenue growth is exceptionally strong as well as earnings growth. So that sets a really firm backdrop. And to your point, markets are over the medium term going to look through, we think, additional hostilities to the ultimate end game.
Yeah, no, Mark Tepper, jump in here because, again, markets seem to be, again, looking past the oil shock and trading higher. Is this an earnings story? Is this a longer play?
Yeah, I mean, look, obviously investors right now, I think they're focusing more on AI, CapEx and stuff like that. But from an energy standpoint, Troy, would love to get your take on the energy sector overall. Best performing sector year to date, but it really hasn't done much over the last month. We heard from Diamondback Energy yesterday, the biggest low-cost producer right here in the Permian Basin, that they are going to be ramping up production because WTI's, $100 to $105 a barrel. What is your take on the energy sector throughout the rest of the year? Is it somewhere you want to be, or is it too late?
We'd say it's in the later innings, right? Because if you think through the end game for this, assuming we can get some resolution in the Gulf, whether it's through additional kinetic action or through some type of peace agreement, remember the producers have been cautious. You're highlighting one example of RAN production, but they've been cautious because they do expect, just like futures markets, oil to drop back down. But I think the bigger picture point you're making is very important for people to remember. The U.S. is an energy exporter now. It's very different than the first or second Gulf War. Our economy is much more resilient to these shocks. Yes, GDP growth in terms of consumption will be a bit slower, but a lot of that extra revenue will flow to energy producers, which can reinvest that in the U.S. economy over time. So we're in so much better of a place today than we were 10 or 15 years ago, primarily because of American ingenuity and fracking, which can't be lost in times like this.
Yeah, absolutely. And we were just talking in the segment before you about the fact that this could be the boom that American energy has needed and is now getting under President Trump. I mean, drill, baby, drill is happening. I want to take a look at yields with you this morning because we've got a big week of jobs data. You've got March JOLTS out today. You've got ADP for April tomorrow. The expectation, 99,000 private sector jobs. And then, of course, all eyes on April jobs report Friday. 62,000 non-farm is the estimate. The rate holding steady, 4.3%. Troy, you write big picture. The labor market has evolved from white hot to warm, but has fortunately avoided a darker fate. What do you mean by that?
Yeah, so the best way of thinking about the evolution of the U.S. labor market is we were in an unsustainably white-hot environment for quite some time coming out of the pandemic. You had 2 job openings for every unemployed person. You had record low unemployment, and that helped precipitate inflation. Right? I mean, the main cause was printing a ton of money and doing massive fiscal transfer payments. But it was also a white-hot labor market. So the labor market's evolved from white-hot, unsustainable, to what we consider warm, and based on some historical metrics, still relatively leaning towards hot. So this idea that the labor market's collapsing or there's some type of imminent recession just isn't borne out by the facts. We have about 0.93 job openings for unemployed people, still considered very tight, close to record low unemployment. We don't need to create the same level of jobs we used to because obviously immigration's been constrained dramatically. And then looking past that, Cheryl, even more importantly, if you look at the consumption power of the consumer, and I think withholding tax growth is the best way to view this in real time. Well, all we've done is go from a 6 to 8% growth rate to a 4 to 5% growth rate, trending towards 5. And you have seen job creation reaccelerate. So, the consumer isn't as mighty as they were in terms of generating 2.5% of real economic growth this year. But the consumer is certainly good for 1.5% or better.
Right, I understood. So, Troy, what are some smart investment strategies that our viewers should consider to best position their portfolios? Where can investors look for some safety?
Well, yeah, so in terms of overall asset allocation, we're clearly big fans of U.S. listed equities, but the question is, what do you complement that with that can give you similar or competitive returns over time without taking uncomfortable levels of risk? And one of our key strategies focuses on middle market private equity, where we're helping small and medium enterprises grow at revenue rates that exceed the S&P. And importantly, your valuations tend to be a third that of listed equities. So you have this growth at a very reasonable price, which really drives positive outcomes without taking undue risk. So that's a great complement that we offer to listed public equities in terms of growth.
Troy Gayeski, it's always great to have you on the program. Thank you for being here, Troy.
Thank you.
All right, we're going to be right back. Everybody stay with us.